Hi, I am Ankur Sharma from IIM Ahmedabad, and today let's talk about the risk-free rate. So what is the risk-free rate? Simply put, it is the return on an investment that has no risk. It is the basic return you expect when you take no risk at all. So in most cases, we use the return from government bonds as the risk-free rate. Why? Because we trust that the government will repay its debt, so there is almost no risk. Now, why does the risk-free rate matter? Well, it's a starting point. When you compare different investments, the risk-free rate helps you see whether the investment is worth the risk or not. For example, if a government bond gives you 5% return and a stock is only offering 4% return, the stock is considered riskier and you might think twice before investing in it. Also, it's used to figure out things like net present value or NPV, which helps investors decide if a project is worth investing in. For example, if a company is looking at a new project that will earn $10,000 in the next 5 years, but the risk-free rate is 3%, they need to see if that $10,000 is worth more today than if they just invested in a risk-free bond. Well, we will go deeper into NPV in another video, so don't worry if you don't understand this part, or if you're not familiar with that right now. So, where do you find this risk-free rate? It's often based on the government bonds, especially those from stable countries like the US. These bonds offer a return that is considered safe. Now, there are two types of risk-free rates that you might hear about: nominal and real. The nominal rate is the return without adjusting for inflation, while the real rate takes inflation into account. So that's the only difference. For example, if the nominal rate is 5% but the inflation is 2%, the real risk-free rate would be 3%. Well, that example was for US. For India, suppose the nominal rate is 6.5% and the inflation is 5.5%, so the real risk-free rate is 1%. So the real rate shows you the true value of your return. Now, here is a fun thought. If your investment isn't earning this real risk-free rate, तो समझ लो कि भैया आप बड़े वाले हो. This means you are taking on extra risk and your returns should be higher to justify that risk. So if you're not getting more than the real risk-free rate, maybe it's time to reconsider your investment strategy. And as a spin-off, I'll tell you that suppose there are when you're comparing two investments, for example, so suppose one investment is considered less risky and it is supposed to give you some returns, say 10% or 12%, and suppose the other investment is considered more risky and that investment is also giving you 8% or 10%, that means again you are making a fool of yourself. You should not do that. So that way, coming back, interest rates set by the central bank like the Federal Reserve in the US or RBI in India can affect the risk-free rate. When they raise or lower rates, the risk-free rate usually moves with it. For example, if the central bank raises interest rates to 4%, the risk-free rate is likely to increase as well. To wrap it up, the risk-free rate is the basic return you get with no risk at all. It helps compare investments and it is important for many financial models. So thanks for listening. If you find this helpful, be sure to follow Investment Inc. on Facebook and visit moneysphere.in and bookmark it for more investment insights. Bye bye.